Hi, this is Shelley Kraft. We're coming to you live on SNN Live. We're at the 40th Annual New Orleans 2014 Investment Conference. I'm here with Rick Rule, Sprott. It's a publicly traded company, and the symbol is SII. He's a featured speaker at the conference. Rick, welcome back to SNN Live.
Always a pleasure, Shelley. Thank you for having me.
Now, you're a speaker. What's the topic? Because I know the market has been going sideways, up and down. You tell me.
I think my title, if I remember correctly, is "You've Suffered Through the Pain, Why Don't You Hang Around for the Gain?" And my thesis is going to be that natural resource markets are quite cyclical, and that bear markets are the authors of bull markets, which we've talked about on your show before. It's my belief, Shelley, that for serious speculators in natural resources, we will look back at last year, this year, and perhaps some of next year, and we will say, those were the good old days. Stuff was so cheap. The competition for opportunity was non-existent. When markets are dear and we're looking around for bargains, we will look back at this point in time and say, that was the biggest sale. I can't believe I didn't participate more fully.
I walk around a conference, a resource conference, and I look at the last man standing. I think that there's luck in that. There's a lot of hard work in that. And I think that it's a testimony to how much money they have, how much money they have left, and how much money they put into the ground. You want to comment on that?
Exploration and speculation requires hard work, cash, and courage. People's expectations of the future set by their experience in the immediate past. That's why bull markets go so stupidly high and why bear markets go so stupidly low. If your experience in the immediate past has been bad in a bear market, your anticipation of the future is bad. If your experience in the immediate past has been good, your expectation is good. What causes a bear market to become a bull market, this is important for your viewers, what causes a bear market to turn into a bull market is that the market exceeds expectation. And the expectations are so low right now, Shelley.
It won't take much.
The hard thing to do would be to get under the bar, not over the bar. Now, when is it going to happen? I don't know. Is it going to happen? Depending on how you view things, this is my fourth or fifth cycle. Day follows night. Bear markets are the authors of bull markets. Bull markets are the authors of bear markets.
Here's a good question that I have had asked of me. When you have the Dow Jones Industrial Average going up and down like a thermometer from summer to winter, how do you calculate what the price of gold's going to be versus what the Dow is?
I don't. I look at the price of gold versus the U.S. 10-year Treasury, the anti-gold. I think that gold is locked in a war with the U.S. dollar. The 10-year U.S. Treasury, from my viewpoint, is pretty easy to value. You look at the expected value of the return. They're paying you 2.1. Their measure of inflation is going at 2.1. So the U.S. Treasury absolutely guarantees that you'll tie up your money for 10 years with no return. That's their guarantee. Jim Grant calls the U.S. Treasury return-free risk. If you use my calculation of inflation, what the basket of goods and services that I consume to live, my belief is that my purchasing power is going down by 5% a year, not 2.1% a year. Do you know, Shelley, that the CPI inflation, never mind that it doesn't cover food and fuel, which is problematic for both you and I because we obviously eat, but the CPI doesn't include tax. Now, if I didn't have to pay tax, I wouldn't complain so much about the index. But if you believe that the purchasing power of your basket of goods and services is declining by 5% a year, then the value offered up by the U.S. 10-year Treasury is, in 10 years, they'll take away half your purchasing power. And gold is locked in a fight with an instrument that could cost you half your purchasing power in 10 years. We're going to win. I don't know when we're going to win, but we are for sure going to win because we can't lose.
So let's focus on the outcome of the next possible phase in the rise of gold. Comment.
Well, past is prologue. Past is prologue. I mean, the first time in my career that nobody cared about the gold price was in 1970 at $35. 10 years later, it was at $800. I wrote a piece in the year 2000, the next cycle, a little article called A Case for Gold. Not the case for gold, a case for gold. Just trying to state that there was a case for gold. The price was $260. It ran to $1,800. The truth is that gold's job is to maintain its purchasing power. It is very volatile. You know, it underperforms, it outperforms, but it maintains its purchasing power over time. And when you have the opportunity to purchase gold or gold-related proxies in periods of time where nobody cares about them, it has always proven to be a very good thing to do.
Is it a good thing to be in the exploration business today, or is it not a good thing?
That depends on you, not the exploration business. Nobody cares about exploration. So if you require psychological gratification, if you require the concurrence of the crowd, you're going to get killed in this business. But the business has been so good to me, I mean, so astonishingly good to me, that when I look at people crowding out of the market, I just sort of chuckle with glee. You know, the interesting thing about exploration is that it's much less commodity price dependent than people believe. If you have a company that makes a large discovery, almost irrespective of commodity price, the rewards are spectacular. We've been, by all estimations, in a very poor market. Reservoir Minerals makes a discovery. It goes from 32, 33 cents to $7. Africa Oil makes a discovery. It goes from 80 cents to $12. You get my point. Value creation is spectacular. And if a good discovery happens to happen in concurrence with an increase in commodities price and an increase in sentiment in the sector, then truly wild things happen. Shelley, you remember the last uranium boom. One little stock, Paladin Uranium, went from a penny and a half to $10, and it did it in 4 years. That's why people are in the sector. To the extent that they aren't, my apologies to them.
Well, also it takes other companies with them. You know, there's almost like that focal trend almost is magnetic to other companies' stock to go with them. What do you think about that?
Well, that goes back to the point I tried to make earlier. People's expectation of the future is set by their experience in the immediate past. That's why bull markets overshoot on the upside, why bear markets overshoot on the downside. That's just the way it works. Bear markets dampen expectation, the market exceeds expectation, gives way to a bull market, and then the whole paradigm is reversed. And it happens every cycle.
So it doesn't make sense to make a prediction because you have historical data.
Well, I mean, it depends on how specific you want me to be with the prediction. I'm old enough.
Very, as much as you can. Give me it. The investors, this is why they come and watch.
I'm old enough that even an old pro like you isn't going to get me into the corner.
Well, let's take a shot at that.
Well, what sort of prediction are you looking for, Shelley?
Let's stay focused. Rather than focus on the price of gold, I'd rather focus on the near-term future for exploration companies. I think there's probably more tangible ability to do that. Near-term
future, lousy. The exploration companies have played chicken with the market. They haven't raised money. They haven't financed. They're trying to survive. Survive is a strategy that only preserves management's salary. It's not a strategy that makes money for investors. We are, I think, finally going to go through a liquidation cycle where many of these companies go to company heaven. And that will further depress the sentiment of market speculators. My hope is, and I say this sincerely, my hope is that we enter the capitulation sell-off phase that we've talked about in our interviews before. The capitulation sell-offs are absolutely terrifying events, and they set up absolutely spectacular rebounds. So my hope is that right now, in October, we are entering into a capitulation phase for the juniors where the general market, the general junior market, literally goes no bid. And a whole bunch of companies go to company heaven, or else they go to a new business that they have experience and understand, like marijuana.
Like marijuana. It's a good way to end this, by the way, on a high note. But let's get some information. Tell us a little bit about Sprott and what you're doing there.
Well, Sprott is, I think, the largest, and I also believe the finest, microcap resource money manager on the planet. We manage or administer about $10 billion. We're publicly listed on the Toronto Stock Exchange. Our symbol is SII. We do resources, resources, and resources for the most part. And by the way, mostly small cap resources and precious metals. That's what we do.
Now, let's send folks to the website. What is that?
You can find us on the web at www.sprottglobal, that's SPROTTGLOBAL.com, or call us toll free at 800-477-7853.
Some people have that in their speed dial, by the way, ladies and gentlemen. I'm Shelley Kraft. This is SNN Live. This is Rick Rule from Sprott, publicly traded company SII. He's a featured speaker at the 40th Annual New Orleans 2014 Investment Conference right here in lovely New Orleans. Thanks again, Rick, for coming on to SNN Live.
Pleasure, Shelley. Thanks for the chance.
Good to have you.